Hi everyone, my name is Dinesh Balachandran and I'm here to talk about a new fund that we are launching called SBI Balanced Advantage Fund. We have a presentation that I intend to walk through to explain how we are essentially going to manage this particular fund. Let me start off by sharing two quotes that I think are quite appropriate here. One is by probably the most famous investor, Warren Buffett, where he says that you only have to do a few things right in your life as long as you don't do too many things wrong. The second quote is doing well with money isn't necessarily about what you know, it's about how you behave. And in my opinion, when I think about balanced advantage fund, these two quotes are essentially an integral part of why we think this fund is appropriate for many investors, and it's also sort of integral to how we go about the portfolio construction process for this particular fund. When you look at equity markets, it is an undeniable fact that equity markets do go through cycles. Instead of ideally, we would want a smoothly increasing market through time, but it doesn't really work like that. You see markets at certain points that are sort of at a very extended point in terms of valuations, and then sometimes you go through the other end of the spectrum where valuations become very attractive, but people are very scared to invest in the markets at that point. So this whole cycle of fear and greed, euphoria and depression, these are factors that we just can't wish away. These are integral to the functioning of the equity markets. Now, when we think about what an ideal investor should do, the idea would be to then sort of act in a counter-cyclical manner, which means that you buy low and potentially sell high. When markets are in a very attractive zone, you want to increase your allocation to equities. When markets are in a very expensive zone, you might want to sort of increase allocation to other asset classes. That way, you are essentially not only not getting disturbed by the cycle, you are even potentially taking advantage of the cycle that's there in the markets. But the question is, does it really happen? Do investors follow this nice strategy of buying high and buying low and selling high? It's unfortunately not the case. When we look at the data and look at monthly net inflows into equity mutual funds, what we find is that when the valuations are not expensive, the average inflow is much less compared to the points when markets are quite expensive. So when we are showing this table that has data over the last 7 years, you can see that when the P range for Sensex was between 15 to 20, the average inflows were not so great. It's only when the P range moved higher to the 20 to 25 zone that the inflows picked up. And the problem with this is that when you get in at an entry point like that, and due to some natural calamity, I mean, COVID-19 obviously is the most recent example, but whatever exogenous shock there might be, let's assume the markets move to a very attractive zone from a valuation perspective. The problem is when you have entered at a very high point of the cycle and markets turn south significantly, you are likely to panic, and you are likely to potentially sell at the worst possible time. And this is the basic issue that we see with respect to uh, the general investor behavior. So instead of buying low and selling high, often people do the reverse of actually buying high and potentially selling low. And this is something that we definitely want to avoid as much as possible. Now, timing the market in any asset class. So, for example, in equities, timing the market is quite tough. When you look at the past 1 year data and you see what happened with respect to the markets and then with respect to equity net sales. What you can see is what we just discussed, that essentially only after returns really started picking up, we are now sort of seeing more inflows. Ideally speaking, the inflows should have been much higher in March or April 2020. So basically, timing the market for most investors, it is a very difficult task. Now, timing within equity itself is tough, but then when you think about sort of multiple asset classes, when you bring debt into the picture, when you think about like multiple asset classes, then timing becomes even more difficult. Now we know that you want to have a good equity allocation for long-term wealth generation. That is for sure. But what happens is that over short to interim time periods, the winners across asset classes keep rotating. So what we are showing here is data for the last 13 years. What we find is that equity is outperformed in only 7 out of those 13 years. The remaining 6 years, some other asset class did much better. So, from a short to intermediate time horizon perspective, you do see the winners, are different depending on the time period that you are looking at, and so timing across asset classes is also a very difficult task. Now, when you think about an asset class like debt, or when you think about money markets or liquid funds, yes, they are lower return in nature, but they also are lower risk in nature. So when you construct a portfolio that not only includes equities but also debt and cash, then what you find is that the overall portfolio definitely becomes much better from a risk perspective. So here, what we are showing are two charts. The first chart is the standard deviation of Nifty, the equity benchmark, and standard deviation for the composite bond fund index, which represents the debt asset class, and the CRISIL liquid fund index, which represents the cash or money market asset class. And you can clearly see that the volatility of Nifty is much higher, and so that can be a potential issue for certain investors. On the right chart, what we are showing is the rolling 3-year correlation between Nifty and the debt asset class and the cash or money market asset class. And you can see that the correlation is quite low to negative actually, between these asset classes. So then what happens is that when you combine these three asset classes in a single portfolio, then the risk return profile can sort of like significantly be enhanced, and that is why for many investors who are wary of the volatility or the drawdowns that one often sees in pure or 100% equity mutual funds, this can be a much better solution. Yes, you will be sacrificing a little bit of return, but what you gain in terms of mitigation on the downside, mitigation of the significant drawdowns, that risk, that can really be better by combining these three asset classes into a single portfolio. So one can then think, how should we go about it? Fine, yes, trying to think about uh, multiple asset classes, trying to vary the allocation between these asset classes makes sense. But how do I actually go about doing it? One option is where you can develop a good understanding of equity markets, debt markets. You then try to figure out which stocks do I want to buy within the equity asset class, which securities do I want to buy within the fixed income asset class. You can keep a track of how these markets are changing. Upfront, you create a strategy in terms of what should be the ideal asset mix under different conditions, and then based on the changing market conditions, you can adjust it. So you can then sort of do rebalancing periodically, and now the one problem as an individual investor is that the whenever you are exiting a stock, you also have to now think about the taxation aspect, like how much taxes do I need to pay while rebalancing, and so on. So it's not that you can't do it, but clearly there are a lot of moving parts that you need to think about, and there are a lot of balls that you need to juggle for doing it in a proper manner. The other option is you leave the worrying to us, and you say that if there is a fund which can essentially take care of these things in a proper manner, let me invest in that fund, and that way I will leave the worrying to these people. And that is the proposition that we have with regards to the SBI Balanced Advantage Fund. So let me now go into the details of how we are going to manage the SBI Balanced Advantage Fund. What we are trying to do here is we are telling investors that we will aim for long-term capital appreciation. We will try to do it in a manner where we will try to capture most of the upside that one sees while investing in equities. So we want to capture most of that upside. But what we also want to do is we want to limit the downside risk that one sees when equity markets become very volatile. So the idea is to capture most of the upside, but but limit the downside risk. Now, how are we going to do it? From a very broad top-down perspective, the idea is to have the flexibility to have a wide range for these asset classes. So the asset allocation is going to be varied in a dynamic fashion, and that is something that we truly aspire to do. And the focus is on achieving superior risk-adjusted returns. That's the basic endeavor of this particular fund. From a taxation perspective, what we are hoping to do is through a combination of long equity and arbitrage, we'll have an overall allocation to equity greater than or equal to 65%. That way, the fund, we endeavor to achieve equity taxation for the fund. Now, in terms of the exact strategy, how do we go about doing it? How do we go about constructing a portfolio for such a fund? We like to think of it as a three-layered process. Step one is the asset allocation component. In this step, we are trying to decide how much to allocate to each of these asset classes. But we don't want to stop there. We also want to think about a step two. Step two is where, even within equity asset class, we want to think about how much should we allocate to large cap stocks, how much should we allocate to mid cap stocks, how much to allocate to cyclical stocks versus defensive stocks, how much to allocate versus growth stocks versus value stocks. So the strategy or the tilt of the portfolio will be decided in step two. And finally, last but not the least, we will have step three, where we essentially do the actual stock selection for building the portfolio. So we essentially will use all these three steps to construct what we think would be a robust portfolio that can weather different market environments. Now, let me go through these steps in detail so that you can understand how we go about actually doing what we are seeing. For step one or tier one, where we are essentially trying to figure out how much to allocate to equity, how much to allocate to fixed income, we are using an objective framework that has three factors: valuations, sentiment, and earnings. Now, what we have seen is that each of these components are quite critical for determining an optimal asset allocation mix. Valuation is something a lot of people will intuitively understand is important for figuring out asset allocation, right? But what we are trying to do here is when we talk about valuations, we do not want to just think about absolute spot valuations. One, we want to compare equity valuation with debt valuation, because what we've seen across markets over time, that the absolute valuations do not matter as much as relative valuations. And so when we think about equity valuations, we want to think about where are equity valuations relative to fixed income valuations. On top of that, we do not want to just think about what is the current PE, because the current PE, the current price to earnings ratio, can be quite noisy and volatile. What we want to do is we want to think about valuations based on earnings that are averaged over an entire economic cycle. That way, we are essentially trying to capture what earnings can do across a cycle. We think this is much more important than just thinking about the current trailing earnings or current forward 12-month earnings. So we want to think about cyclically adjusted earnings when we think about valuations. Now, valuations are obviously very integral and very crucial. But what we also know is that markets can remain overvalued or undervalued for extended periods of time. And that is where the sentiment part really comes into the picture. What we've seen is that sentiment indicator can be a good contrarian indicator when thinking about prospective market returns. What do we do here? In the sentiment indicator, we look at several factors, but broadly speaking, we are trying to see how are the market internals, how are small cap and mid cap stocks doing compared to large cap stocks, how are cyclical stocks doing compared to defensive stocks. These are parameters that are very important for figuring out the health of the market, so to speak. On top of that, we also want to think about positioning and flows. Are mutual fund flows now reaching extreme levels, either on the positive side or on the negative side? From a retail participation perspective, is the sentiment at this point excessively optimistic or excessively pessimistic? From a primary market or IPO perspective, are we seeing a deluge of IPOs, or is there a big scarcity of companies coming to the public market? So these are all very important sentiment measures that we've aggregated, and finally we have created an in-house sentiment index. The way it will work is that when the sentiment index reaches what we call as the euphoric zone, or an excessively optimistic zone, from an asset allocation perspective, we really want to fade that. So when equity sentiment is very high, we would like to reduce our allocation to equities. And when equity sentiment is very low, very suppressed, we want to increase allocation towards equity. So these two measures put together can give a very robust way to think about how much to allocate within equities, how much to allocate to fixed income. A third step that we use as an overlay is also thinking about the earnings outlook. When earnings are strong and improving, we want to take that into consideration, because all else being equal, when that is happening, you would want to increase allocation to equities. On the other hand, when earnings are weak and deteriorating, you want to sort of reduce equity allocation, all else being equal. So finally, we are using all three factors, and then it's done in a very objective framework, and that allows us to figure out how much to allocate to equity and how much to allocate to fixed income. So that was the tier one, or the step one. Now let's talk about the second step, or the second layer. Here, as I said, once we've decided on a certain equity allocation, we also then want to think about the market cap allocation, and the style skewness. How much to allocate to value versus growth, how much to allocate to cyclicals versus defensives. And this, again, we want to use an objective framework to help us make a decision on this. Because we think this step can also add meaningfully to the investor returns in this fund. So step one was the asset allocation. Here we have a framework that allows us to also think about how much to allocate across each of these factors. Then we have the final step, which is the stock or security selection. Here, what we are trying to do is we have a very big research team where each of these analysts are the respective sector specialists. They've been tracking their sectors for a long period of time, and they are the experts when it comes to their particular sector. So every month, we ask our analyst team to submit their highest conviction ideas. These are the ideas that the analysts feel the most strongly about. Now, when we want to pick stocks, we will pick stocks from this highest conviction ideas list. That way, the stocks in this portfolio essentially represent the best ideas of the fund house. So we feel very good about it, and we think that this can also meaningfully add alpha to the overall fund. Now, on the fixed income side, what we hope to do is we want to think about fixed income from a liquidity perspective. So, in general, on the fixed income side, we would want to minimize taking credit risk. So, the securities on the fixed income side would primarily be very highly rated corporate bonds or GSECs. That way, the liquidity of the fixed income portfolio is not compromised. So accrual as a strategy is not going to be very actively employed to generate alpha. On the fixed income side, duration management will be the primary tool to generate alpha. So by actively managing the duration of the portfolio, we hope to generate alpha on the fixed income side. So when you put it all together, how or what are we doing here? We essentially have a nice framework to think about asset allocation. Then we have a framework to decide the style skewness, where we are talking about market cap breakup or allocation across value, growth, cyclical and defensive stocks. And then finally, the actual stocks, which are based on the highest conviction ideas of the analyst team here at SBI Mutual Fund. And on the debt side, duration will be very actively managed, and the fixed income portfolio will have minimal credit risk. So, from an investor perspective, what are they getting with this fund? One, diversification, because this fund will invest across asset classes. That way, the risk reward component becomes much more balanced. Two, the asset allocation will be managed in a dynamic fashion. It will be managed in a counter cyclical fashion. This will definitely help from a return perspective. And we also have good flexibility in this fund to vary the asset allocation across asset classes. So, who should invest in this fund? We think investors who are looking for long-term wealth creation, they should definitely consider this fund. Now, in particular, risk averse equity investors or investors who are comfortable taking on some credit risk but are wary of the significant drawdown that can sometimes be seen in 100% equity mutual funds. This is a good fund for those investors, but we would like those investors to come with a minimum 3-year investment horizon. And investors who essentially are looking for a dynamic solution in terms of determining the optimal mix between debt and equity. This is the perfect fund for those investors. So here are some of the fun facts for the SBI Balanced Advantage Fund. So we have myself and Gaurav Mehta will be managing the equity portion. We have Dinesh Ahuja will be managing the debt portion, and we'll have Mohit Jain, who is a dedicated fund manager for managing overseas investments. If you guys need any further clarification, please feel free to reach out to us. Thank you so much. Hope you will consider investing in this fund. Thank you, and please stay safe.
Mutual fund investments are subject to market risks. Read all scheme related documents carefully.